Good afternoon, everyone, once again, and thank you for joining us today. My name is Balram. I'm a chartered accountant, and we have the spectrum auditing for last 10 years in Dubai. And we provide audit, accounting, tax, transfer pricing, company formation, and other services. So, along with me, I have Girish. He is also chartered accountant. He's been working on corporate taxes from the beginning for many years. So, I'll let him introduce once he starts speaking. So today's session will be more about the CT returns filing. Last time we covered most of the basics and then the various forms or schedules that we have rather than the form itself we've covered by going through each the form page, which we have 8 pages. And then we have covered some other important concepts of the corporate tax law. And now this time we want to cover more about the elections that we have as part of the CT return filing and filing works. In addition to that, we also want to cover various schedules, the important schedules which are part of the CT return filing that happens. Depending upon the applicability, those schedules will be opened up while filling up the CT return form. So, in addition to these two areas, we also want to cover the qualifying free zone person status, conditions to get the benefit of ZP, and a few other important concepts around QFZP. So, these are the three areas that we want to focus because these are the relevant ones to talk more about when you go for seat return filing. As this is the first time that you're doing, all the elections are going to be very important to analyze first and decide based on the analysis as to what is more relevant or more appropriate for your business. And these elections, most of them, once you elect in your first tax return, then they are to be continued forever unless FTA approves otherwise. So that is the reason why we want to focus more on this because it is one-time election. These are one-time elections. So most of the times, some of the written filing or taxpayers may or may not be aware of these elections, and then they end up in selecting or electing something which may not be a right one for them. So that is the reason why we just wanted to look and analyze a bit more on these areas so that when you file on your own, then you are informed or well informed about these decisions or these elections. Some of them you could have done before. Most of them, yes, of course, you can do now also. So while filing the CT returns, of course. So, but even if you go for some elections, some of the information that you are expected to possess was supposed to be there already. But anyways, nevertheless, we look at those and see what are the elections and then how they will impact your business. So just to touch base on the few basic points, basics of the city law. As we know, we have 0% tax that is applicable for the qualifying free zone persons, the entities which are in free zone and which are eligible to get the status of qualifying free zone person. So they will get the benefit of 0% on their qualifying income and 9% on the taxable income which is not qualifying. So you will still be continued to be called as qualifying prison person, but on that portion of income which is not qualifying income, so there 9% tax will be given or levied straight. And on the rest of the income which is qualifying income, on that the tax rate is 0%. If you are a free zone person qualifying to be a qualifying prison person. And for other free zone entities other than qualifying free zone persons, as well as mainland entities and other taxable persons, the taxable tax rates are 0% tax up to the profit or taxable income of 375,000 dirhams and 9% in excess of 375,000 dirhams. Every taxable person is expected to file the returns. Of course, if you're not registered already, you are supposed to register. There could be a penalty for delay in registration. And then after which you will have to submit the tax returns. For most of the entities, the tax return filings are due now before this 30th June because most of the company's financial year is January to December. The CT return filing period is 9 months from the end of the financial year, which is why I mentioned that 9 months is getting over by 30th June for most of the companies where their financial years are January to December. However, if any company has got any penalty for delay in registration, so they should be submitting their first corporate tax returns within 7 months to be able to get the penalty waiver. So this is applicable only when you do it for the first time, or when you do first time first CT return filing within 7 months from the end of the financial year, first financial year, for which this CT is applicable. As I mentioned, the CT return form, it has got 8 parts in it, which we have gone through in our last webinar. In these 8 forms, we have 20 schedules which are relevant based on the business that you have. Some of the schedules may be applicable or may be relevant. Some of the schedules may not be relevant based on your business. And we have about 6 elections which we will be talking about. So all these elections, again, it may or may not be applicable for you, but these are the elections that are available as part of the CT law. And further guidance was given in the form of cabinet decision and ministerial decision, as well as the guidance notes. So as you know, the election, the CT return filing that is happening. This is based on the self-assessment basis. So that is the reason why you should be aware of these elections and make sure that you are making the decision of elections by going through the relevant information and performing the analysis. So this is what I wanted to cover as part of the basic introduction. I would invite Girish to take the things forward and discuss more in detail about the elections. If you have any questions during the course of the session, you can drop in your question in the chat box. Maybe that question will be addressed over a period during the course of discussion. If not, then we will try to address them at the end of the session as part of the Q&A session. So, but if even then, if it is not addressed, we will try to reach out to you to answer those questions. But at the same time, the responses that we give is based on the limited information that is available to us. So it is advisable for you to take the decision only after cross-checking the corporate tax law or the guidance notes and decisions that are available on the website of FTA. So with this, I would like to invite Girish to take the things forward. Over to you, Girish.
Thank you very much, sir. Good afternoon, everyone. So this is CA Girish Ramani here, the corporate tax lead in Spectrum Auditing. Just like sir mentioned, these were some of the quick basics, about the corporate tax law, who are required to file, what are the tax rates, and what is the due dates for the filings. Now, we earlier 3 weeks ago we had taken a seminar wherein in detail we discussed the entire corporate tax return, which is also available on YouTube, wherein you can go and see. So all the 8 parts basically of the corporate tax return we have discussed point by point over there. In this webinar, we are going to specifically cover in detail the 6 election options which the authorities have provided, and also some of the key schedules which are attached to those elections, and other than those elections also whatever the other important schedules are there which may be applicable or relevant to the larger taxpayers. We will be trying to cover them, and also we would have a little detailed discussion on the qualifying free zone percent benefit as well. So to start with, basically the first election option which has been provided is the realization basis. So realization basis, a brief was given in the previous session, that is, uh, as per the books of accounts, you may be following accrual basis of accounting. IFRS generally prescribes you to follow an accrual basis of accounting. That is, in the books of accounts, you are going to recognize the gains and losses on unrealization basis as well. If you foresee any loss, you can provide for that. That provision is also recognized in your profit and loss, and an expense is debited in your P&L. However, for the corporate tax purpose, the authorities have provided an option wherein you can choose to recognize those unrealized gains and losses on realization basis. Although for the purpose of accounts, you have debited, credited all your unrealized gains or losses, however, only for corporate tax purpose. If you make this election of realization basis, there is no need to change your financials. It is only for corporate tax purpose certain adjustments are going to be made. wherein the unrealized gains and losses will be disregarded. They will be excluded from your taxable income, and they will be recognized when you actually earn, when you actually realize those gains or losses in the future tax periods. So there are two types of realization basis options that are available in the law. The first one is for all your assets and liabilities which are subject to fair value or impairment accounting. This is for all assets and liabilities. The next is only for assets and liabilities which are held on capital account. Okay, so in layman terms, capital account assets and liabilities would be any non-current assets and liabilities. So you can choose to elect for realization basis in option 1 for all your assets and liabilities, and in option 2 only for your non-current assets and liabilities. Now again, this election option becomes very important in the first year because this is a one-time election, it is an irrevocable election, and it has to be made in your first tax return itself, which will be applicable in your subsequent years and may have tax implications in your subsequent years as well. Now, there has been a recent development which I would like to just cover. So basically, as per the applicable accounting standards, that is IFRS, if you are recognizing IFRS, if you are recognizing any investment property, uh, as per the applicable IFRS, the investment property which is recognized, if you have chosen to recognize it on fair value basis, then depreciation would not be allowed for the purpose of IFRS. However, the authorities have recently come up with a decision telling that for the purpose of corporate taxes, again only for corporate tax purpose, if you are following if you have been recognizing your investment properties at fair value, then depreciation can be recognized on that. And what would be the depreciation? It would be lower of 4% of your original cost or the tax WDV. So tax WDV would be the WDV after reducing 4% of your original cost every year basis if you have made this election. And basically it is like a 4% SLM depreciation or the WDV, whichever is lower, that is the tax depreciation that is allowed on your investment properties. Again, this is only for your corporate tax purposes. It will not have any impact on your financials, but this is also one time election that you have to make to recognize your investment properties, whether you want to claim depreciation for corporate tax purpose or not. Now let us understand this realization basis election with some examples. So there can be four cases. Okay, we can discuss each case one by one. So first case is if you have any unrealized gains on non-current assets, that is assets or liabilities which are held on capital account. Examples of that can be any revaluation gain on your PPE on intangible assets, or any fair valuation gain on any investments or shares that you are holding on long-term basis. So these are non-current assets liabilities where you have got any kind of revaluation or fair valuation gain. Now, if you do not choose for any realization basis, then such a gain will be taxable. There would be no adjustment that would be required. However, if you choose for realization basis for all your assets and liabilities, this gain would not be taxable, and therefore you will have to reverse that gain. And again, if you go with the second option of realization basis, that is realization basis only for non-current assets and liabilities. Since these are non-current assets and liabilities, the revaluation gain or fair valuation gain again would not be taxable now because they are all unrealized. They will be taxed only when they are realized. So in this year, when you earn this unrealized gain, it will not be taxable and you'll have to reverse that gain. Now, similar will be the treatment for your unrealized losses. For example, impairment of PPE or investment property or any fair valuation loss on long-term investments. Under default option, it is going to be deductible, no adjustment. Whatever is your book treatment will be your tax treatment. And again, under both the realization basis options, for all assets as well as for non-current assets liabilities, such loss would not be allowed as deduction and you will have to disallow it. Now, unrealized gain on non-current assets or liabilities, any fair valuation gain on short-term investments or any other current asset liability. Again, default position, there's no adjustment. It will be taxable. Whatever is your accounting treatment will be your tax treatment. However, if you go for realization basis for all assets and liabilities, it is not taxable because all assets, even your current assets are covered over here. So any gain on current assets will also not be taxable. And again, if you choose realization basis for assets liabilities which are held on capital account, since this is not a capital account asset liability, again unrealization basis is only going to be followed. So book treatment will be your tax treatment, and accordingly no adjustment would be required. Any kind of fair valuation gain would be taxable. Now, again, any unrealized loss on current assets or liabilities, for example, provision for doubtful debts or unrealized loss on inventories, any write down in the value of inventories that you do, these can be some examples. For default position, that is, if you are just going to follow the position as per your books of accounts, no adjustment, your book treatment is your tax treatment. If you follow realization basis for all assets and liabilities, you will have to disallow this loss, because in all assets liabilities, even your current assets and liabilities are covered. So it will not be deductible. You have to disallow it. And then if you choose realization basis only for your non-current assets and liabilities, then since these are current assets liabilities, then realization basis are not going to be applicable on this. You need to follow the book treatment. Again, no adjustment would be required. So basically from this table, it is very clear. If you do not choose for any kind of realization basis, that is, if you choose the unrealization basis only, which is the default position, then in that case, no adjustment would be required. Your book treatment is going to be your tax treatment. Whatever is the nature of your asset, whether it is current asset, non-current asset, everything. So in the third column, if you see, there is no adjustment required under for any of the assets or liabilities. If you go for realization basis for all assets and liabilities, you will have to reverse the unrealized gains and losses for all your assets and liabilities. And in the last column, if you see, you only have to reverse the gains or losses on non-current assets or liabilities. That is the first and the second row. The third and fourth row, no adjustment would be required, because those are pertaining to your current assets and liabilities, and they will follow the book treatment itself. So basically, with this example, now it would be clear that what are the options that are available. One is the unrealization basis, and the other two are realization basis. Under realization basis, one is for all assets liabilities, one is for only your non-current assets and liabilities. So in the first year itself, the management, the companies need to analyze what is their business model, what kind of gains or losses on unrealization basis generally accrue to them, and which option is going to be beneficial for them. And that option has to be decided and selected in your first tax return itself, because this is going to be an irrevocable option, irrevocable election. It cannot be changed in future years. So the companies need to decide and make the election in the first year itself. Now coming to the tax return. In the tax return, you will see that same two options are going to come. First, they are going to ask what is the option, whether you want to go with the realization basis or not. You can select no or yes. If you just want to go with the default position, that is unrealization basis, you can select no. However, if you want to go with the realization basis, please select yes. Again, realization basis benefit is not available for banks and insurance providers. So if you select yes, again the options will go away. So if you select no, then the two options of realization basis are going to come. One is for all your assets and liabilities, and the second one is only for the assets and liabilities which are held on capital account. After making that selection, in the subsequent parts, when you go in the corporate tax return, there will be a realization basis schedule that you need to fill, unrealized gains and losses schedule. Over here, you will have to provide the details of the asset or liability on which the unrealized gain or loss has been accrued, the net book value, and what is the amount of unrealized gain or unrealized loss which has been recognized. So basis this, there will be an automatic adjustment wherein the unrealized gains or losses will be disallowed or removed from the taxable income basis whatever election option you have chosen, and basis the schedule that you are going to fill in over here. So just selecting the option is not relevant. You also have to go and fill this schedule if at all you have, you know, you had any unrealized gains or losses during the period. Now, after the realization basis, the second election option is the transitional rules. This also in detail along with examples, it was detailedly discussed in our previous session. However, just to give you a brief, This is an election, to exclude the gains or losses in respect of certain assets or liabilities which did not pertain to the years after the tax was implemented. That means any pre-tax period before 2024, whatever gains or losses you would have accrued, but they are getting recognized in your financial statements now in this year. In that case, there is an option to exclude such gains from your taxable income. Now, over here, what are the assets? One is gains recognized on qualifying immovable property or qualifying intangible asset. The next is gains and losses recognized on qualifying financial assets and qualifying financial liabilities. So, if you, for example, if you have held any immovable property before 2024 and there has been a, an appreciation in the value of that immovable property, and if you sell it after the tax has been implemented, then the capital gains that will be recognized in your P&L is going to be your entire capital gains appreciation that has happened since you have held till the time you have sold. However, any gain which pertain to before 2024, that gain can be identified and it can be excluded as per the corporate tax law. And you need to pay tax only on the gain amount which pertain to after 2024. So this adjustment becomes very important because this helps in grandfathering. It helps in removing or excluding your gains which pertain to pre-tax period. So any pre-tax period gains can be excluded for these specific assets. Now again, this is a first time election, a one time election, an irrevocable election, and it has to be chosen in the first tax return itself. Therefore, it becomes very important for the companies to analyze and make the election properly while filing the first tax return. Now, again, just to give a brief, in the corporate tax return, you are going to select wherever there is, if you are holding any qualifying immovable property, intangible asset, or financial asset liability, please select yes. For immovable property only, you will have to fill the schedule in the first year itself. That is when you are holding it. You need to give the details of all your immovable property, the Makani number, the details of your plot, where it is situated, the date of ownership, your original cost, net book value, everything. And then when you have disposed it off, you will have to tell for what value you have disposed of, and you need to give the details of the gains which were pertaining to pre-tax period. That is the amount of excluded gain from the taxable income, so that that income can be excluded from your taxable income when computing your tax liability. For all other assets and liabilities like qualifying intangible assets or qualifying financial assets, financial liabilities, no schedule has to be filled at this level. You need to fill the schedule giving the details of your assets and liabilities only when you have actually sold that particular asset or liability. Now, another important point to be mindful of over here is the election option for realization basis for a qualifying immovable property is available for each immovable property independently. That is, you can choose to have this transition rule benefit for one immovable property and then choose to not have this benefit for your second immovable property or your third immovable property. So this benefit is available for each immovable property on an independent basis. However, for your qualifying intangible assets and qualifying financial asset liability, you need to choose whether you want transition rule benefit for that entire category together. When you have actually sold it, there are certain disclosures again. Like we saw for qualifying immovable property, you need to give all those details. Similarly, in the year when you have sold that intangible asset or your financial asset liability, in that year you will have to fill the relevant schedules for your qualifying intangible asset and qualifying financial asset, financial liability as well. Again, the details are going to be the same. You need to give the details of the asset or liability, what was the original cost, what was the gain pertaining to the pre-tax period that has to be excluded, and all those things. So after this thing, the amount that you would have given, that this is the amount of pre-tax gain or loss which needs to be excluded, that will be automatically adjusted against your profit to reduce your taxable income to that extent. And again, this is a one time election. It needs to be chosen in the first year itself. So it becomes important for the companies to decide whether they want to use this election. Then it is important to analyze if you have got any intangible asset or any financial asset liability which is covered under this benefit, and then elect accordingly. Now, to quickly sum up again, this third small business relief, it was covered in detail in our previous session, wherein, this is transitional benefit which is provided by the authorities. The authorities understood that the law is very new, so therefore they have excluded certain small businesses from filing a detailed return, giving all the detailed disclosures of the return. They have given an option that any business, any small business can file a simplified return after, just small disclosures about the revenue, certain other information, and making the elections of realization basis and transitional relief basis. You can just end your return over here. Any subsequent parts of the corporate tax return would not be applicable. You are not required to fill them. Your tax return would end over here. And then in this case, irrespective of the quantum of your profit, there is no tax levied. So if you are a small business, by small business, the authorities mean if your revenue is within 3 million dirhams limit for a tax period, then you can opt for this benefit. So if you have made this election, there is a simplified return and there is no tax liability on such businesses. Then who is eligible? This is available only for resident persons, that is companies who are incorporated in UAE only. Any non-resident person cannot avail this. Then the second thing is that your revenue should not exceed AED 3 million. Now, there are certain exceptions who cannot avail: people who are a part of MNE group, or second, if you are claiming the QFZP benefit. If you want to take the 0% tax rate benefit, then small business relief cannot be availed. Both of them cannot be availed simultaneously. You will have to avail the qualifying free zone person benefit in the first year and file a detailed return giving all the disclosures. So these people, they cannot avail the small business relief. All others, subject to fulfilling the necessary conditions, they can avail this benefit. Again, like I mentioned, this is only a momentary benefit which has been provided. Only up to financial years ending before 31st December 2026, this benefit would be available. That means if you're following Jan to December as your period, then 2024, 2025, 2026, for a period of 3 years at least, you can take the benefit of the simplified return filing, wherein you don't have to pay any taxes. You have to give just limited disclosures about your revenue, about certain election options, and just file your return. It is a very simplified process for them. However, if you are an MNE group or if you want to avail QFZP benefit, then small business relief cannot be availed. Now, another important question that would come over here is, what is your revenue? In general parlance, revenue generally means revenue from operating activities, that is, from whatever operations that you're carrying out, whatever is the sales that you're generating, that is the revenue. However, the corporate tax guide has clearly explained that the revenue for 3 million threshold that you're going to see, that revenue would include your revenue from operations, any kind of other income, any interest income, any forex gain or loss, or any kind of other income that you would have earned, any miscellaneous income, that is also going to be covered over here. Also, any sales proceeds from the sale of your assets is also going to be covered over here. This is very important over here because in general parlance, revenue does not include such amount. Basically, if you have sold any kind of PPE, any kind of vehicle, any kind of asset, then whatever is the sales proceeds from the sale of that asset, that also needs to be considered over here and included in your revenue to be checked against the 3 million threshold limit. So it is important. Revenue does not only mean revenue from operations, it includes all these items. You need to aggregate all of them and see if still you are eligible to avail the small business relief. Another important benefit of this relief is that financial statements attachment is not mandatory. If you go for a detailed return, that is, if you do not opt for small business relief, then attaching financial statements is mandatory. You need to prepare and maintain IFRS-based financial statements. There is no exclusion for that. Financial statements have to be prepared and maintained, and they have to mandatorily be attached along with your tax return. However, if you are going for the simplified return for the small business relief, then financial statements maintaining is also optional. Like I mentioned, if you want to go with QFZP benefit, it is important for you to take that benefit and not choose the small business relief. The second thing is that the law tells that since we are not going to tax your profits, we are also not going to allow you to carry forward the tax losses. So if you have tax losses also, you need to rethink whether you actually want to take small business relief and forego your losses. You need to do the cost benefit analysis and only make the election accordingly. So just because the 3 million revenue threshold are fulfilled and other exceptions you're not falling in that, it doesn't mean that small business relief is only beneficial for you. You need to see various other aspects and then decide, because the elections or the options that you choose now would have implications on your tax in future years as well. Now, qualifying group relief. This is the fourth election option which is provided under the corporate tax law in the corporate tax return. What is a qualifying group relief? Basically, just to give you an understanding, a qualifying group uh, relief means if you are a member of a qualifying group and you transfer any of your asset or liability to another member of a qualifying group, then the transfer of such asset or liability is going to be considered that you have made the transfer at net book value only, and no gain or loss will be recognized, or it won't be taxed for the corporate tax purpose. It is going to be ignored. So basically, the benefit of qualifying group relief is that there there is it allows a tax neutral transfer between the members of the qualifying group. The asset liability will be treated as transferred at net book value, so no gain or loss arises, and whatever is the consideration, it is going to be considered that it is equal to the net book value only. Again, no impact on your financials. In your financials, you may have recognized gain on transfer of the asset to this company. However, if he is a member of qualifying group and you elect for the qualifying group relief, then the gain on the transfer of asset will be disregarded, and also the cost for the other entity to whom the asset has been transferred will be taken as the net book value only. Now, what are the conditions for availing the qualifying group relief? First thing is that the transferor and transferee must be juridical taxable persons only. That is, you need to be a juridical person. It is available only for the companies or other incorporated partnerships or other juridical persons. It is not available for natural persons or sole proprietorships. And you need to be a taxable person. That is mandatory. That means if you are a non-resident person having a PE, still you are a taxable person and it may be allowed. If you are a resident person, it would be allowed. However, if you are a non-resident person who is not having any PE in UAE, then such a person would not be a taxable person, and for such person, the benefit would not be allowed. Basically, you cannot claim this benefit just by transferring any asset from UAE to any company outside UAE, which is not a taxable person in UAE. Basically, they wanted to restrict this benefit for the transfers which are happening within UAE itself. The second condition is that there must be at least 75% of direct or indirect ownership between the two members of qualifying group, or a third person should have at least 75% of common ownership in these two companies between which the asset or liability is being transferred. Then you should not be an exempt person. You should not have claimed the QFZP benefit. Both the companies must follow same financial year and same accounting standards. If all these conditions are fulfilled, both the companies would be considered as members of qualifying group, and any asset or transfer between them can be freely transferred without the need of recognizing any gain or loss. This is a very important benefit of this qualifying group relief. Since this can happen only where there is 75% of ownership interest involved, this automatically becomes your related party transaction also. And under normal parallel, such a transfer should have undertaken at market value, that is on an arm's length basis. However, the benefit of availing qualifying group relief is that the ALP requirement would not be applicable in this case, because this is a benefit that the law is providing you. It is allowing you to transfer on net book value itself and not to recognize any gains or losses. So ALP requirement would not be applicable where you are choosing qualifying group relief. Also, it is important to note that this is available only for your assets or liabilities which are held on capital account. Again, only non-current assets or liabilities, not current assets or liabilities. Then, after you have availed this benefit may also be lost if within 2 years you transfer that asset or liability outside the qualifying group to any third party outside the group. Within 2 years, you cannot transfer. If you have transferred, the benefit will be reversed. Everything, all the entries, all the adjustments are going to be reversed and you have to pay the taxes. Second thing is, if any of the person, the transferor or transferee, cease to be members of the same qualifying group. That is, the ownership interest came down below 75%. That is how you lost the qualifying group status, or that company has been liquidated or it has been shut down within the period of 2 years. In that case, also it would cease to be member of the qualifying group. So if any of these things happen within 2 years from the date of transfer, then this benefit is going to be reversed, this relief is going to be reversed, and you will have to make the adjustments again back to the original one, how the transfer had been undertaken. Now, in the corporate tax return, what are the things that you have to fill? Basically, you will have to choose whether any transfer has been made to another member of qualifying group. Yes. Then whether you want to avail this relief or not, you need to make an election. Would the taxable person like to make an election for qualifying group benefit? If you select yes, then in the subsequent parts, you will have to fill out a schedule wherein you need to give the name of the other party with whom you have done the transaction. What is the TRN of that other company? It is very important because the FTA at the back end, they are going to check both the returns simultaneously in such cases to see if one company has excluded the gain properly, other company has excluded the loss properly, and whether actually they have made the adjustments to show the transfer at net book value basis only. Is the taxable person a transferor or transferee? Whether you are a transferor or transferee, you need to select that. What is the proceeds? What is the actual consideration that you have received from them? What was the net book value, the date of transfer, and what was the gain or loss in your hands as a result of this transfer? And whatever amount you are going to enter over here is going to be excluded while computing the taxable income. So this was in relation to the qualifying group relief. So you need to decide, you need to just analyze if all the conditions are fulfilled during the tax period when the transfer is being made, and whether you want to make that election or not. And accordingly, you need to fill the relevant schedules in your corporate tax return. Now, the fifth election that we'll be speaking of is business restructuring relief. Again, this is something similar. That is, the benefit that the law provides is that if you have undertaken any business restructuring, then in that case, whatever businesses or assets liabilities that have been transferred as a result of that business restructuring, that will be considered to have been undertaken as per the net book value basis, so that no gain or loss arises. All the assets and liabilities will be treated as if they have been transferred at their net book value. Now, one important condition is that business restructuring relief can be availed only where the business or part of the businesses have been transferred, and they have been transferred in exchange for shares or other ownership interest only. If you have done a demerger or a merger or any transfer of your business in consideration in return for a monetary consideration, then in that case business restructuring relief may not apply. A mandatory condition is that such a transaction should have happened in exchange for some shares or other ownership interest only. Examples can be conversion of sole proprietorship to legal company, or certain mergers, demergers, etc. are going to be covered in this relief. Now, what are the conditions for business restructuring relief? Few of them are similar, like to the transferor and transferee must be juridical taxable persons. They should not be exempt persons, should not have taken QFZP, should follow same financial year and same accounting standards. However, other two additional conditions are there. One is the business restructuring that you have undertaken, that is legally compliant. It complies with all your regulatory laws, applicable legislations, and everything of the UAE which are applicable. On the mergers, demergers, you have undertaken necessary approvals, you have followed the other laws, the company laws, and everything. The next condition is that you should have undertaken such a business restructuring for valid commercial reasons. You should be able to substantiate the business rationale behind undertaking such a transaction. It must reflect economic reality. Such transactions should not have been undertaken, just for the purpose of avoiding any kind of taxes. In that case, the business restructuring relief would not be available. Therefore, it is important that you should be able to substantiate the commercial reason for undertaking the business restructuring. One important thing over here is that there is no condition in relation to the ownership interests. Like in qualifying group relief, the 75% ownership interest requirement was there. There is no such requirement. That means the business restructuring relief may be between related parties or it can be with third parties as well, and this relief can be availed in that case as well. Now, similarly, there are clawback provisions over here as well. That is, within 2 years of undertaking such business restructuring, if you do any of these two activities, then the relief would be lost, and whatever relief was there, you'll have to reverse it. So, if you do a subsequent transfer of business for which the business restructuring relief was claimed, if that business has been again transferred to any other person within 2 years, or the transferee of the business restructuring that happened, any change in shareholding happens outside the qualifying group. That means if the transferor's shares have been transferred to any person which is outside the qualifying group, or if the transferee's shares have been transferred to any person which is outside the qualifying group of which the transferee was a member, then in that case this benefit would be lost. So the transferor or transferee's shares can be transferred to another persons of the same qualifying group. In that case, this benefit would not be lost. Again, here whole or part ownership is written. That means even if one share of transferor or transferee is transferred to a person who is not a member of qualifying group, same qualifying group to which that person transferor transferee belonged, in that case this benefit would be lost if even one share is transferred within 2 years. So these become some important conditions of business restructuring relief, a brief backdrop about this relief and when this is available and how can this be availed. Now, the important disclosures or reportings that are required in the return is, again, you will have to select whether any business restructuring has happened for which the business restructuring relief may apply and whether you are electing for that relief or not. After that, again, the TRN of the other company is important, the name is important. What is uh what is the status of the taxable person, whether it's a transfer or a transferee, you need to mention that. What have been the proceeds and the net book value, and resultant what was the difference, the gain or loss that was recognized in your financial statements that you would want to exclude, whether this gain or loss was recognized in financial statements or not, that is also important to be reported, and then the amount of such gain or loss, then that is going to be excluded while computing your taxable income. So this is the fifth election option which has been provided. The realization basis was first, second was transition rules, third was small business relief, then qualifying group relief, then business restructuring relief. Now the next one is your foreign permanent establishment exemption. This is the sixth election which is provided. Basically, if you have got any operations outside UAE, which is a foreign PE, which constitutes your permanent establishment outside UAE, then in that case, you can make an election to disregard such foreign PE's income or expenses. So, in your profit and loss or balance sheet, ideally you prepare it for the entire company, in which your foreign PE's result is also included. However, for corporate tax purpose, you can completely eliminate the results of your foreign PE. The income as well as the associated expenses, you can just exclude it computing the for the purpose of computing your taxable income. Now, an important condition for availing this exemption is that the foreign PE in its foreign jurisdiction should have been subject to tax of at least 9% or more. If it has not been subject to any tax, then in that case, foreign PE exemption would not be available. So at least 9% tax the foreign PE should have paid in that country. And if you avail foreign PE exemption, then FTC would not be available. So foreign PE exemption or FTC, either of these two can be availed, both of them cannot be availed. So if you go with foreign PE exemption, then FTC is not going to be available. Again, does the taxable person has foreign PE? You need to select yes in your corporate tax return. Whether you want to make the election, please select yes. Foreign PE schedule will pop up wherein you have to give the details of your eligible foreign PE in the current tax period. Give the details of your taxable income or tax loss which is attributable to the foreign PE. Whatever amount you enter over here is going to be excluded from your taxable income straight away, and that is not going to be considered for your corporate tax purposes. So that is the benefit of this election which has to be made in the corporate tax return. So basically with this we come towards the end of the six elections that have been provided under the corporate tax law, and how the respective reportings or the respective elections have to be made or they have to be selected in your corporate tax return. These are very, very, very important because they certain elections are irrevocable. All these elections may reduce your taxable income. They may benefit the business in some form or another, and therefore the disclosures and the reportings that you do in the tax return is also very, very important. So these were the six elections and the other associated schedules also with regard to those elections we have seen along with the elections itself. Whatever schedules are applicable for the elections, we covered them. Other than that, what are the other important schedules that may be relevant for you? Let us try to cover them. The first important schedule is any income or loss that you have reported outside your income statement. Okay. Basically, this schedule is relevant if you have recognized any kind of gain or loss in your balance sheet directly, or you have any gain or loss which is not routed through your P&L. That gain or loss has to be reported, and that has to be considered in computing your taxable income. This would also include if you have got any gain or loss in your other comprehensive income which is non-reclassifiable in nature. The reclassifiable other comprehensive income or expense is going to be reclassified to your statement of P&L whenever it is realized. So there is no problem with that. However, if there is non-reclassifiable other comprehensive income, then you need to make that adjustment over here again. Then other things under the IFRS, if you have got any kind of non-adjusting balance sheet, non-adjusting events after your balance sheet date, or any kind of prior period expenses incomes that you directly routed through your general reserves or other reserves in your balance sheet, you will have to take that into consideration and you will have to report them over here, which will be adjusted in your taxable income. So even if any gain or loss that you have recognized which is not routed through your P&L, that needs to be taken into consideration. So this schedule is very important because this considers any balance sheet gain or loss, any gain or loss that has directly gone into your balance sheet. What are the disclosures that you would have to make is that firstly you will have to select if any gain or loss has been there which will not be subsequently reclassified to your statement income statement. And in that you need to give the description of the asset or liability pertaining to which that income has come. What is it, whether it's an unrealized gain or loss. Then if you have chosen for realization basis, it is going to be excluded because it would be an unrealized gain or loss, and it would be recognized when it has been actually realized in the subsequent periods. So you need to report any unrealized gain or loss directly going into your balance sheet has to be reported over here even though you're going for realization basis. Just select realization basis and it may not be considered over here, but the disclosure has to be given. It will be considered in the future year when you actually realize it. Then give the details of the cost, the net book value, and the income or loss which has directly gone into your balance sheet and it has not routed through your profit and loss, and that will be taken into consideration in the above portion, which is the gray area, and it will automatically be adjusted with your taxable income. Automatically be adjusted to derive the taxable income. The next important schedules are exempt income related schedules. Again, this is very important because this is an exemption. The law has provided an exemption for certain dividends and capital gains. So to avail that, it is very important to fill the schedules and appropriately disclose in your tax return. The first is that any dividend schedule, UAE dividend schedule, that is, the law tells that if a company derives any dividend income from another UAE company. That is, any dividend from domestic companies, domestic dividend are completely exempt without any conditions. So if a company has got any dividend from another UAE company, it is completely exempt. You just have to give the company's name, company's TRN, and the dividend that you have received, the profit distribution that you have received. Whatever amount you are going to report over here, that is going to be excluded while computing your taxable income. The next exempt income schedule is participation exemption schedule. Participation exemption schedule. To understand, before going into the schedule, let us have a brief of what are the participation exemption conditions. Okay, so basically, what participation exemption is: any kind of dividend, capital gains, forex gain or loss, anything that you derive from participation interest, participating interest, is going to be excluded for corporate tax purpose. Again, dividend here would be any dividend except for domestic dividend, because domestic dividend is exempt irrespective of your participation exemption conditions. Dividend, domestic dividend is straight away exempt without seeing any conditions. So if you receive any dividend from foreign companies, in that case, participation exemption becomes relevant. Capital gains, whether capital gains is on sale of shares of UAE companies or non-UAE companies, you'll have to see participation exemption, or any other gain that you derive from them. Now, the conditions for participation exemption are: first, you should have at least 5% of ownership interest, which entitle you to 5% of profits or liquidation proceeds both. Now, an alternative for these two conditions is that if the acquisition cost in the participating interest has been at least 4 million dirhams, then both these conditions are deemed fulfilled. So it is an or condition. If the acquisition cost is at least 4 million dirhams, then both these conditions are fulfilled. You should have held or intended to be held for at least 12 months. Even if 12 months are not over, you can claim this benefit. However, later ensure that you have held the participating interest for at least 12 months. If you sell your shares within a period of 12 months, then in the next tax period, your participation exemption is going to be reversed and all your gains are going to be taxed. The next condition is the participation must have been subject to corporate tax of at least 9%. Whether in UAE or outside UAE, wherever the participation is present, wherever the investee company is present, it should have paid tax of at least 9%. It should have been subject to tax of at least 9%. Then there is a asset condition. That means in my participations balance sheet, if there are any further investments that my participation is holding, and those further investments would not qualify for participation exemption had I held them directly, then the value of such further investments that the participation is having must not exceed 50% of its total assets. That means if I am holding, if I being a company, I am holding any investment in another participation, and that participation has got further investments, then the total of the assets of that participation has to be taken, and the value of the further investments that it is holding, it should not exceed 50% of its total assets. This condition is very important because this has to be analyzed, and the analysis of this involves analyzing the financial statements of your participation as well. So basically, you're not just going to see the conditions between you and your participation. This condition requires you to analyze all these conditions for the further investment also that your participation is holding, if at all they are holding any kind of further investment. So if all these five conditions are fulfilled, then participation exemption benefit would be available. Now, how the reporting in the schedule goes. Now, when we see the schedule, we'll see that all the conditions the authorities are trying to see if you have analyzed whether they have been fulfilled. So it asks you the name of the participation, it asks the country of jurisdiction of that participation, then it asks the TRN, and also it asks you confirmation if that participation has been subject to tax of at least 9%. Then later you'll have to fill what has been the nature of your income or loss, what has been the amount. Then it also requires you to mention the percentage of holding that you have had. And then if you open the schedule, you would see that it also asks you if all other conditions of participation exemption have been fulfilled. So basically 9% tax rate, 5%, all these things it has asked. And then for all other conditions, there's a checkbox that you'll have to do that all other conditions of participation exemption have also been fulfilled. And then report the relevant income or gain that you want to claim participation exemption for. Once you report that, that is going to be excluded while computing your taxable income. So these are the two exempt income related schedules. One is a UAE dividend schedule, that is a domestic dividend that is straight away exempt. You just have to give the details of that income. The next is participation exemption schedule, where certain incomes are excluded subject to fulfilling these conditions. And for that, all these reportings are required, wherein you have to disclose whether all the conditions have been fulfilled or not. The next important schedule is your tax losses schedule. The tax loss schedule is very important if you want to carry forward your tax losses. Okay, so as per the corporate tax law, you can carry forward your tax losses for indefinite period. You can carry it forward for unlimited period and set off against your future tax periods profits. Basically, you can set off the future profits against the losses that you have incurred now and reduce your tax liability in future years. And this can be carried forward for indefinite period, provided at least 50% of the ownership remains the same. This is very important. If the ownership of the company has changed, then you may not be able to carry forward the tax losses. The tax losses will go away. However, if you continue to carry out the same business even after the change of ownership, then in that case, you may still be eligible to carry forward the tax losses. And the maximum set off that is allowed is up to 75% of your taxable income. That means 25% of your taxable income is still offered to tax. So at any given time, you cannot completely set off your profits against the past losses. Maximum set off is allowed up to 75% of your taxable income only. Balance tax losses, whatever have been unutilized, you can continue carrying it forward to the future years and again set off in the future years, again up to maximum of 75% of taxable income in that particular year itself. Now, other than this, for tax losses, there is another important benefit, transfer of tax losses. The law allows you to transfer the tax losses. Again, the conditions are more or less similar to qualifying group relief conditions. So basically, if you are a member of qualifying group, in layman terms, if you are a member of qualifying group, just like you are transferring other assets liabilities, you can also transfer your tax losses. So you should both the companies, both the persons from whom tax losses are being transferred and to whom they are being transferred, they must be resident taxable persons. 75% of direct indirect ownership interest must be there or common ownership must be there. It should not be an exempt person, should not claim QFZP, should follow same financial year and same accounting standards. So all these conditions are similar, just like a qualifying group relief. Again, maximum transfer also that you can do is up to 75% of recipient's taxable income. Just like set off is allowed up to 75% of your taxable income, transfer is also allowed only to the extent of 75% of recipient's taxable income only. If you open the schedule, you will have to fill the relevant details. What is the tax loss which is brought forward? That is going to automatically come from your past returns. The tax losses incurred during the year, tax losses which cannot be allowed to be carried forward, which have been utilized during the year, any other adjustments, plus minus, whatever has been transferred, everything is going to come over here. In the beside schedule, you'll have to fill the tax losses claimed for from other taxable persons or where you are transferring to other taxable persons. The details that would be required is the name of the transferring entity and the TRN. Again, TRN is mandatory because they are going to cross verify the tax return of the other company to whom tax loss has been transferred or from whom the tax loss has been received to ensure that it has been appropriately done. And the amount of tax loss that is transferred, that also needs to be disclosed. Now coming to your tax credit schedule. In the tax credit schedule, the tax laws allows you to claim the tax credit for any taxes that you would have paid in the foreign jurisdiction. So if you have any presence outside UAE and you have paid any taxes, then in UAE, since worldwide income is taxable, even the foreign income would be taxable. However, against that, foreign tax credit is allowed. Now, again, just to reiterate, foreign permanent establishment exemption and foreign tax credit cannot be availed together. If you go with the foreign PE exemption, then all incomes and expenses for foreign PE are excluded upfront. If you do not claim foreign PE exemption, then FTC can be availed. However, the amount of FTC cannot be more than the tax that you would have paid in UAE had that income be taxable in UAE. So it is going to be the lower of the tax that you have paid in foreign country or the tax that you would have paid in UAE. And unutilized foreign tax credit cannot be carried forward to future years. This is an important point to be mindful of. So if in the corporate tax return, if you see there would be a corporate tax liability, then you can select if you have got any foreign tax credit, then foreign tax credit would be reduced. It would be reduced from your corporate tax liability, and the net corporate tax payable amount is going to be computed. Now, when you select yes that you have got certain tax credits, then the foreign tax credit schedule needs to be filled, wherein you have to give the details of the country where you have got the operations, what was the income, and what is the tax liability that you have paid. You need to confirm if you have got the evidence. It is important, just like financial statements. Even the proof of FTC has to be mandatorily be attached. We have discussed in detail in the previous session as well. The proof for foreign tax credit needs to be mandatorily attached. What is the nature of tax credit? You need to give the details. If it was a federal tax or corporate tax only, then it would be allowed. Then UAE corporate tax due on the amount. If that income would be taxed in UAE, then what would be the amount of tax? The lower of the two is going to be your tax credit, which is going to come in your last field in the FTC schedule. Now, related party transaction schedule and connected person schedules, they have been covered in detail in the previous session. If aggregate value of your related party transactions exceed 40 million, per category exceeds 4 million, then you need to give the details, the name, the transaction type, the value, the TP method, and everything. Again, these are only the thresholds for the disclosure. There is no disclosure requirement for your benchmarking exercise. You have to ensure that all your related party transactions are on an arm's length basis. The opening balances of your balance sheet are also on an arm's length basis. There is no threshold benefit for that which is available. Even the smallest amount of transaction has to be ensured that it is as per the market standards, as per arm's length basis. Now, connected person schedule, again a similar thing. If you have made any payment to your owner, to your KMP, any salary or any kind of payment that you have done, any benefit that you have provided, if the value exceeds 500,000, then the disclosure has to be made. Again, this is a threshold which is provided only for disclosure. Any value of benefits or salary that you would have paid, if it is less than 500,000, also you need to benchmark and ensure that it is on an arm's length basis. There is no threshold for ensuring that the connected person transactions are an arm's length basis. This revenue threshold is provided only for the disclosure in the tax return. The authorities can always come back and ask you to give the details even if the value has been less than 500,000. So basically, the important schedules have been covered. So we have covered 5 to 6 kind of schedules along with the relevant election options only which are there in the tax return, and the other key schedules also we have covered other than the election options which are there. There are various other schedules, some which would be applicable from second year, some relating to your interest expense, the general interest deduction limitation rule, and few others as well. However, the major key schedules which would be applicable, which would be more relevant, all of them have been covered over here. Now, moving forward, we can discuss the provisions of qualifying free zone person and the related disclosures in the tax return that you have to make for availing this 0% benefit. Now, qualifying free zone person benefit. As you are aware that all the free zone companies have got the benefit to avail the 0% tax rate. However, for any free zone company, the 0% tax rate is not automatic. You need to fulfill certain conditions to avail the 0% tax benefit. Now, what are those conditions? To discuss briefly, one is that you need to ensure that there is adequate substance in the free zone. That means you have just not floated a company just for the purpose of availing the 0% benefit. You are actually undertaking the transactions from there. You have got adequate substance over there. There are adequate employees, there are adequate assets, there are adequate expenses that are being incurred in the free zone. There is no specific number that the law has provided. If you have got these many number of employees, then it is adequate substance or anything. It depends on case to case basis. The companies should be able to substantiate that whatever number of employees, assets, or expenses that they are incurring in free zone is adequate for earning the benefit, for earning the income that they have earned. The next condition is that the company must derive qualifying income. It should not have elected for normal tax regime. All the related party connected person transactions must be as per ALP, where TP documentation is applicable. TP documentation is being maintained. The de minimis requirements are not breached. Basically, the de minimis requirement is any company. This is basically some buffer which is provided by the corporate tax law. It tells that all companies, they cannot only derive qualifying income. They may have parked certain funds and they would have earned certain incidental income in selling the scrap or selling things related to that. So any income which is not a qualifying income, if that income is up within 5% of the total revenue, if it is within that limit, then you are not going to lose the QFZP benefit. You can avail the QFZP benefit even if you have derived any income from non-qualifying activities or any income which is not a qualifying income, subject to that being within the 5% threshold only. So this is small buffer which is provided by the corporate tax law. And then maintaining audited financial statements is a very important condition for availing the qualifying free zone person benefit. Now, what is your qualifying income? Just to cover briefly, a qualifying income can be any income that you have derived while transacting with other free zone persons or that has been derived from qualifying activities. So any of these two you should be doing. That is very important. You should have derived any income from at least another free zone person or from qualifying activities. So the income should be from any of the qualifying activities or another free zone persons. If these two things are there, then that income is going to be considered as a qualifying income. Any of these two should be there. However, any income from excluded activities will not be considered as qualifying income. We'll see briefly what are the list of qualifying activities and excluded activities. Then any income from exploitation of qualifying intellectual property is also going to be considered as qualifying income. And like I mentioned, if within the 5% threshold, if you have earned any other income which is not a qualifying income per se, that means it is not income derived from another free zone person or it is not derived from qualifying activities, it is something else, then if that is within the 5% threshold, then that is also going to be considered as qualifying income and 0% rate is going to be available on that as well. Now just to quickly cover the qualifying activities, so basically they have covered majorly relating to goods. They have covered the manufacturing activity. If you are engaged in processing activity, if you are doing trading of qualifying commodities, or if you are doing any distribution activities or logistic services. So relating to goods, majorly these are the things which are available. Again, if you are just a holding company which is holding shares for investment purpose, that is at least for a period of 12 months, if you are holding any shares and you are doing no other activity, then that is also a qualifying activity. Any reinsurance services, fund management, wealth management services, if you are providing any headquarter services to your related parties such as HR role, HR function, any payroll function, or any common R&D that you are doing, so any kind of headquarter services that you are providing to your related parties, that is also covered over here. Treasury and financing is covered. Financing, leasing of aircrafts, and ownership, management, operation of ships, these relating to them, they are also covered. So any of these qualifying activities you do, it is going to be considered as qualifying income. Or any activity that you do with any free zone person, then that can be any activity. It should not be a qualifying activity, it can be any activity that you do with another free zone person, that is also going to be considered as a qualifying income. Now, qualifying income cannot be from excluded activities. Any income that you derive from excluded activities is not a qualifying income. What are the excluded activities? Basically, you should not have derived any income from natural persons. except ownership operation of ships, fund management services, wealth management, and financing leasing of aircrafts. So, except for these four activities, any other income that you derive from natural person is an excluded activity. It is a non-qualifying revenue. Banking activities, insurance activities except for reinsurance is an excluded activity. Financing, leasing except treasury and aircraft financing. Anything, any financing activity other than this is going to be an excluded activity. And ownership or exploitation of immovable property. That is also not allowed. It is an excluded activity. However, if you derive any revenue from a commercial property which is in a free zone and you derive the rental income also from another free zone persons only, then it is not going to be considered as excluded activity. So basically, that was a brief about the qualifying free zone person benefit. Now, in the corporate tax return, you need to select if the company is incorporated, registered in a free zone, is a taxable person making an election for standard tax regime. You need to select no, because you'll have to if you select yes, then you will have to go with the normal standard regime and QFZP benefit won't be available. Then, does the taxable person meet the qualifying free zone person conditions? If you select yes, then there is a detailed schedule, a detailed QFZP part which pops up in your corporate tax return, wherein you need to give the details of your total revenue. If you have got a domestic or a foreign permanent establishment, that is, if you have got any presence which is in mainland or any presence which is outside UAE, which is outside free zone, then that revenue has to be reported and that is excluded. So, for example, over here, if 1 million is your total revenue, out of which 200,000 pertain to your activities which you're doing in mainland or anywhere outside UAE, then that is going to be excluded for checking the de minimis requirement of 5%, and that will be computed only on 800,000. Then whether there is any commercial property, like I mentioned, commercial property in a free zone where the income is being derived from another free zone person is going to be considered, is not going to be considered as excluded activity. So that needs to be reported over here, because again, that income would be excluded from your total revenue for calculating the de minimis requirements. So you need to report any details relating to your commercial property and any details relating to your intellectual property, because qualifying intellectual property, if you derive any revenue from exploitation of that, then that is going to be a qualifying income. After this, you have to give the details of your non-qualifying revenue. So what is your non-qualifying revenue? Any income that was not a qualifying income. That means any income that you have derived from your excluded activities, any income that you have derived from your non-free zone persons, which were not even your qualifying activities, or any income that you have derived in relation to derived from non-free zone persons, basically where the free zone persons were not the beneficial recipients, then that also needs to come over here. De minimis requirement, the 5% threshold is automatically computed basis the non-qualifying revenue details that you give over here. The yes or no is going to come automatically. We cannot do any changes over here. Then in respect of qualifying revenue also, the breakup needs to be provided. How much was from qualifying activities and how much was from dealing with other free zone persons. Then, like I mentioned, there is an adequate substance requirement where you have to show that adequate assets are there, adequate employees are there, adequate expenses have been incurred. For that, they ask you what are the number of full-time employees located in a free zone? What is your total operating expense? What is your total capital expense that has been incurred in deriving your qualifying income? So in total operating expense, it is not just the operating expense. Basically, you can include all your profit and loss expenses that are there, whether they are direct costs or indirect costs. You can include all of them and report the figure over here on an aggregate basis. And for total capital expenses, any capital natured expense that you would have incurred, any capital asset that you would have acquired in relation to the qualifying income, then that from balance sheet you'll have to pull out that figure and report that capital expense over here. If you would have outsourced any activity to any other person, then the details of that need to be reported. Basically, even if you are outsourcing the activity, you do not lose the QFZP benefit, provided you have got adequate supervision over the activities, that person has got adequate substance, and that person is carrying out the activities in the free zone itself. So in that case, you can even outsource it. So you need to give the details about the outsourcing provider, and then you need to explicitly mention whether you have fulfilled all the conditions. Adequate assets were there, employees were there, expenses have been incurred, Related party connected person transactions are at ALP, TP documentation is maintained, and audited financials have been prepared. So basically, FTA is trying to ensure that you know about all the conditions and you have fulfilled all the conditions and are only then claiming the QFZP benefit. So this has been provided. Then you need to give the emirate wise details about your EBITDA and your salaries and wages. If you have got presence only in Dubai, then you need to report all your EBITDA and salaries and wages in Dubai. Otherwise, you'll have to give the bifurcation of your EBITDA and salaries into the different emirates, whatever is there. So basically, with this, we come towards the end of the session. There have been one or two very recent developments in the in on the portal, wherein the portal now requires you to do an OTP validation before using other facilities. uh, so in few cases they have started removing as well, but now the OTP validation is going to come in slowly, wherein you have to validate your mobile number and your email ID that you have given for the authorized signatories. Because they are trying to ensure that they are reachable to the concerned person if they have got any additional queries. So the authorities are definitely going to analyze and assess your tax returns wherever they need additional information, additional clarification, or they have any queries, they are going to reach out to you. That is the reason they are ensuring that you have given a valid and active mobile number and email ID of the authorized signatory which is accessible. So please keep a track of your mobile numbers and mail IDs also, because the authorities may reach out for any queries or any updates on that. And the other thing is that now the tax return also requires you to report EBITDA, EBITDA in your accounting schedule part of your corporate tax return. So these have been some very recent changes which have come up on the portal, which are important to be mindful of. Except for this, I believe in the first session we covered all the parts of the corporate tax return in detail. Now, in detail, we have understood what are the election benefits that are provided by the corporate tax law and how the reportings need to be done in the tax return. We also saw what all other important schedules are there, and in detail, we have discussed the QFZP related disclosures as well. So with this, basically, you would have a fair idea of the corporate tax return, how the filings are there, what are the things that are to be reported, what are the preparedness that needs to be there. And basically, the corporate tax return would not be very simple as it may appear on the face. There are many guidances and guidelines which are there to fill each and every schedule or each and every field of the schedule. So please be mindful of that while filling the return to avoid any questions from the authorities or to avoid any incorrect disclosures, because of which maybe you can lose certain benefits as well. So with this, we come towards the end of the session. Now, if there have been any questions or anything, we can just take them up. Balram sir, you would have anything to add over here?
Girish, you can go ahead and conclude. I think we have a couple of questions in the
Yeah,
chat
sure.
window, and then address them and close it.
If in previous years there are balance of 2 million in due to related party and current year we are sure that it will not be payable, then we write off the payables. Can we claim the transitional provisions benefit, or do we need to pay tax on total amount written off? So basically, ma'am, for this thing, you need to ensure that the financial asset or financial liability that you are having is a qualifying financial asset or liability. For a qualifying financial asset liability, it has to be in existence since previous year, and there has to be some appreciation in the value. In this case, these are normally settled in the normal course of your business. So I don't think that transitional rule benefit may be available over here. However, since it's an intercompany transaction, you can get the benefit under one and claim the expense under the other company. So on a group level basis, there won't be any tax that would be going. Or alternatively, you can explore the qualifying group relief if that can be availed over here. Company registered in Shams, but legal status is limited liability company. For corporate tax return filing, it will be treated as free zone company or mainland company. Free zone, then audit report must for return filing even though company is dormant. So basically, sir, the legal status is a limited liability company, and if it is in a free zone, then it will be considered as a free zone person. It will not be considered as a mainland company. However, whether you will be eligible for the 0% tax rate benefit will depend on whether all the other conditions for the 0% benefit are fulfilled or not. And if you are going to avail the 0% benefit, if you fulfill all the conditions that we just saw, only then the audited financials would be mandatory. Otherwise, maintaining the financials would be mandatory, but they can be the management signed and stamped financials as well. So audit report would be must if you want to avail the 0% benefit and if you are fulfilling the other conditions for the 0% benefit. Even though the company is dormant, financials are mandatory. And if later you are not foreseeing any operations or anything, and if you're not availing 0% benefit, then audit is not mandatory.
I
Yeah.
think Snehaji has got some question, I guess. Oh yeah, thank you, Snehaji.
Thank
Uh,
you, everyone. Yes, the recording would be available, ma'am. So it would be uploaded on YouTube as well, and we'll be sharing the link. Even the previous session, the detailed discussion on the corporate tax return is also available. So you can just see them, and if you have any doubts or facing any issues with your return filing or anything where you need our assistance, you can always reach out to us on this number, mail ID, wherever. You can just text us, maybe on LinkedIn as well. That should absolutely not be an issue, and we would be always there to help.
Great. Yeah, thank you all for joining. Thank you, everyone. And
Thank
we'll
you.
definitely share all the details with you directly. Thank you all. Good evening.
Thank you, everyone.